So on to section B, we'll look at FITCO, which is questions 16 to 20. I always recommend reading the requirements first, because what happens then is when we read through this information, we know what we can do with it, or we've got a better idea of what we can do with it. Whereas if we just read this first, we lose the context and we generally have to just repeat that and read it again later. So the first requirement, based on the cost estimates made, what's the life cycle cost per unit? Question 17, what's the revised variable labour production cost for the new product's life cycle? And just a quick glance there, I can see that's a learning curve calculation. Which two of the following statements regarding life cycle costing is true or are true? And this is an example of the second reason why I like doing this, reading the requirements first, because I can answer that without reading this bit at all. This is probably going to be a simpler couple of marks that I can get, whereas the previous one, this learning rate calculation, is probably a bit more in depth and going to take a bit more time than this one. So it includes forecasts that may turn out to be incorrect. That's true. That's one of the things about life cycle costing. It is based on predicting the future. It ignores post-abandonment costs relating to a product. Nope, life cycle costing should include that. It's generally not used in service industries. No service industries can use it, so therefore it must be this one. It allows managers to make better decisions about launching and discontinuing products, as it shows the costs and revenues associated over its life. Absolutely, that's one of the key reasons to do life cycle costing, is you remember to include all of the costs, not just the per unit cost, also the research and development, decommissioning, all of those other costs. And if the product is then not profitable, you might not go ahead with it at all. Question 19, which of the following costs are typically incurred during the service and abandonment phase? I can see it makes a note about one of the directors, so I'll leave that one for now. And which of the following is true? And I can see that's a probable calculation. So let's look at our scenario. FITCO specializes in the manufacture of a small range of high-tech products for the fitness market. It's currently considering development of a new type of fitness monitor, which will be the first of its kind in the market. It would take a year to develop, with sales then commencing at the beginning of the second year. Products expected to have a commercial life of 2 years before it's replaced with a technologically superior product. Following costs being made, we've got 3 years with a total column, so no sales in year 1 as it tells us. We've got R&D costs, design costs, marketing costs and admin costs. Year 2 and 3 we've got some units sold, so there's going to be some revenue there, continued market costs, and obviously some manufacturing, distribution, selling and admin costs. All costs are specific to the product and ignore the time value of money. So what is the life cycle cost per unit? Well, the life cycle cost is all of the costs divided by all of the units. And often we have to do more working out, but actually they've given us all the information because all of these costs are linked to this product. It tells us they're specific. So we can actually just go straight in for the calculation here. Quite an easy calculation as long as you picked up on that. So 24,690,000 divided by number of units is 300,000. So it's 82.3, which was one of our options here. I suspect some of these distractors were if you removed something, maybe admin costs or year 1 costs or something like that. So what's the revised variable labour production cost for the new product's life cycle? Cost estimates made have not taken into account the learning effect. It assumed a labour production time per unit of 0.5 hours. It's now been estimated that the first unit will take 0.5 hours with a 95% learning curve until the 100th unit's been completed. Labour cost per hour is $25 in both years, and it's given us the coefficient B. You are given the learning curve formula. Here it is. Y equals AX to the B. Well, they've given us the value of B up here. The learning rate's the 95%, but we don't need to use that. We're given B. A is the time for the first unit, which is half hour. Don't forget that minus. It's unfortunate that it is up there. It's a shame it's not sort of tied to the actual number here. So just to make sure we're clear on what's going on, 300,000 units is expected over the entire life cycle, and the calculation on the left assumes that it will take half an hour per unit at a cost of $25 per hour. But now what we're told is the first 100 units, there'll be a learning curve. So the very first unit will take half hour, and that will gradually decline based on this learning curve up to and including the 100th unit. For units 101 to 300,000, that new time will apply to all of them. So we've got two separate calculations, working out what happens between 0 and 100, and then work out what happens between 101 and 300,000. Using the formula that we just looked at, y equals ax to the b. Y is the average time per unit based on a particular number of units. A is the time for the first unit, which is 0.5. Now, if we work out the average time for the first 100 units, and then I multiply it by 100, that will give me the time for the first 100 units. So I'll do the average first, 0.5 times x of 100 to the power of minus 0.0740005. Now, normally, this is what we would type into a calculator, 100 to the power of this, but this doesn't work. This calculator doesn't allow this function. It doesn't like the negative power, and it gives this error. So we have to use a workaround. And 100 to the power of negative 0.074005 is the same as 1 over 100 to the power of 0.0740005, i.e. drop it in the negative. So if we do the 100 to the power, so drop the negative for the first step, 0.0740005, we'll work that out. And that's basically this part that's highlighted without the negative. To introduce the negative, I need to find the reciprocal, and the reciprocal is x to the minus 1. And now I can multiply by the 0.5. So this is the average time per unit for the first 100 units. So therefore the total time for the first 100 units is this. I would retain a useful number of decimal places for now because it's easy to introduce rounding errors in learning curve calculations. Next, we need to do the calculation for 101 up to 300,000. Well, we repeat a lot of what we've done, and in fact we'd have to repeat all of this and then do the same calculation but for 99 units, and then we can compare the time for the first 100 units with the time for the first 99 units. That gives us the time for the 100th unit, and it's that time that applies for all of these units. So I've just copied and pasted that there, but this time that 100 becomes 99. We're going to have to do the same process. So it's 99 to the power of 0.0740005. Then we find the reciprocal, which is this one, and then we multiply by the 0.5. So this is the average time for the first 99 units. If I multiply that by 99, I get the total time, which is 35.2312. Remember, this is total for 99. This is total for the first 100. Therefore, the difference is 0.3294. So instead of taking a half hour from units 101 onwards, it takes 0.3294 hours. So now we need to find the total hours used. This is the time used for the first 100 units, which we calculated up here, 35.5606. And now we need to do the total time for the other units. So it's 0.3294 per unit. How many units have we got? Well, it's 299,900 units because the first 100 are here. So out of the 300,000, the rest will be taken this amount of time. So using my calculator, using the bracket function, 3294. So this now tells me the total number of hours used, and at 25 per hour gives 470,565. So now I have a problem because this doesn't match any of the answers. What I should have said is if the labor cost was 3.75, there's no way it would go up when you apply the learning curve. So it has to be one of these three. So my options now are to recalculate it and see if I've made a mistake, or to choose the nearest one, which is this one. I would probably choose the nearest one and move on. What I will do when I've got to the end is I'm going to come back to this and see what's gone on. My suspicion is that because this mock is not checked like the exams are, I think there's probably some rounding errors that have led to whatever answer has been selected. It is possible I've made a mistake, but I've just paused my recording, had a look through, and I don't think I have. But I will check later. But I'll move on. I certainly won't waste time in the exam going back and trying to find the right answer. Like I say, just choose the one that's nearest. On to 19. Which of the following costs are typically incurred during the service and abandonment phase. 1, decommission of factories. That is during the abandonment phase. So 1 is correct, which means the top one or one of these is correct. Design updating. Design happens right at the beginning, so not during service and not during abandonment. So it's not 2, which means it's one of these bottom 2. Servicing and warranty costs. That would happen during the service phase. And disposing of products as required would happen at abandonment, or maybe even a bit during service. So 1, 3, 4 is the correct answer. Which of the following statements correct? It's now the start of year 2. Unexpectedly, a competitor's launched a product similar to this one, so they now have to launch it at a lower price than expected. The marketing department believes that a price of $75 will be able to sell 100,000 in year 2, which it was doing before, and 200 in year 3, which it expected as well. Costs for 2 and 3, years 2 and 3 would stay the same. No costs during the abandonment phase. Which of the statements is correct? The product should now be abandoned since life cycle revenue is less than the life cycle cost. Well, at the start of year 2, that's not the right decision-making tool because these costs are sunk costs. We can't go back and get these costs back. So it's only what happens from year 2 onwards. So the top line's not correct. Should be continued since life cycle revenue of 22.5 million is more than the remaining life cycle costs. Well, the 22.33 is the difference between these two, so I agree with that. And then the 300,000 times 75 is the 22.5, so that's correct. The product should be abandoned since 75 million revenue in year 2 is less than the year 2 costs. No, that's not the way it works. That's why we look at the whole life cycle, because although the revenue may be less in year 2, it will be more in year 3, so that will make up for that. Should not be sold in year 2 as a loss will be made, but launched in year 3 when expected revenue of 15 million would exceed costs. Well, that wouldn't be a good approach because what would actually happen is the competitor would take over the market and these year 3 predictions would be wrong because year 3 would build on what's happened on year 2. So that's the correct answer. So as I said, I would come back and revisit this one where my answer was different to all of the options. And just to make sure I didn't make a calculation error using the calculator, I've just used a spreadsheet and redone it. So I've got A, X and B. A is 0.5. The first value of X is 100. B is the value, you see I've put the full thing in. And then Y equals AX to the B gives me that calculation multiplied by 100. That's the total time for the first 100 units. Then I've copied all of that and pasted it here, changed that to 99. That's the total time for the first 99 units, which means that's the time for the 100th unit, the difference between those two. So then what I've done is taken the 299,900 units multiplied by that time, gives me 98,791. This is the time for the 100 units. So that's the total time taken, which I've totaled here, multiplied by 25, which is the labour cost, which 2470,664, which was the figure I got, or close to the figure I got, because obviously I did round it a bit. The spreadsheet hasn't rounded it at all. And I had a look at the model answer. They chose this one, 2475,075, and I had a look and there is a lot of rounding in theirs. So they've got both of these to 2 decimal places, and then when they do this, they've got to 2 decimal places, which means this is now 36 in their figures. Instead of this figure, they've got 98,967. So you can see how the rounding's starting to come into play. And when they total those, they get that, and then multiply by 25. That's how they've got their figure. But it is all to do with rounding errors. So I'm going to once again reiterate what I said earlier. For the mock, we do sometimes see things like this because they're not checked by other people. Someone writes the mock and they do it their way. My recommendation is be as accurate as you can in the exam. Like I showed you in the real exam, this would have been checked by the examining team. They would have picked up on this rounding problem and they wouldn't give you a cluster of answers where if you've done it more accurately, you would end up with the wrong answer, which is what the situation is here. What they'd probably do is change these. So when you had your accurate answer, the closest one of these would be the correct one. And I think I said when I started about learning curves in this debrief, try not to round early because it leads to rounding errors. I didn't know I would then demonstrate how a rounding error really looks. But I think it's a good example of how different the answer can be with a bit of rounding. The correct answer that I found was 4,410, different from the rounded answer in the mock model answer. So I hope that all helps. On to the real PICO. First question, which of the three processes, if any, is a bottleneck? That's going to take a bit of working out. Assuming that real PICO wants to maximize profit, max the optimal production plan for Wednesday in batches. There's a bit of information, but there's still going to have to be some calculations and working out there. Which two of the following statements would improve the throughput accounting ratio? When improving the throughput accounting ratio, we can often work out without any numbers or detail. The Real Pie Company has done a detailed review, has identified potential actions to improve its throughput accounting. So first option, a bulk discount on flour and butter is available from suppliers. Well, a decrease in the cost of ingredients or materials would improve the throughput accounting ratio. Restaurant customer given a loyalty discount, that would have the opposite effect because that would decrease the revenue. There's additional demand for vegetable pies in the market. That's not going to have an impact. Rent of the premises being reduced, yes, that would decrease what's called the factory costs and therefore decrease the TPAR. Which of the following statements about TPAR for the previous week is or are true? In the previous week, the weighing and chopping process was the bottleneck and the resulting TPAR was 1.45. Which is true that Pie Company's operating costs exceeded the total throughput contribution generated from its three products. If the TPAR is greater than 1, then the throughput contribution is greater than its operating costs. So it's not 1, which means it's either this one or this one. Less idle time in the mixing and finishing department would have improved the TPAR, or the weighing and chopping process was the bottleneck, so that would have no effect. So it must be 3 only. Improved efficiency during weighing and chopping would have improved. Yes, it would. How much will profit increase if they hire new ovens to produce as many beef pies as possible? That looks like it's going to be a calculation. So I probably need to read this bit first. So let's run through what we're given. Real Pie Company makes 3 types of pie: beef, chicken and veg. Costs, revenues, demand for each are given below. Got selling price, material cost, labour cost, the size of a batch and the maximum daily demand. Pies are made in batches using 3 sequential processes: weighing and chopping here, mixing and finishing in the middle row, and baking the bottom row. Products must be produced in their batch sizes, but are sold as individual units. We're probably told that for a reason, so keep that in mind. Each batch of pie requires the following amounts of time for each process: beef, chicken and veg. The baking stage of the process is done in 3 ovens, which can be used for 8 hours a day. Total of 24 is available, so 8 lots of 3. Ovens have a capacity of 1 batch per bake, regardless of product type. The availability of the other 2 processes varies each day. They use throughput accounting and consider all costs other than material to be factory costs, which do not vary with production. It's a lot of information there. We need to find out what the bottleneck activity is, if any. These generally have quite a lot of steps, but it's quite repetitive. So I've made myself a little table there: beef, chicken, veg, total, and how much is available. So first, weighing and chopping. So beef requires 0.25 per batch. Remember, it's per batch. There are 4 batches, 120 divided by 3, so 4 times 0.25 is 1. Chicken, 0.25 per batch. Again, 4 batches, so that's also 1. Veg, 0.4 per batch, and there's 3 batches, 90 divided by 30, so that's 1.2. Total is 3.2. Available is 2, so therefore weighing and chopping is a bottleneck. There's only an option of choosing one of the 3 or no bottleneck, so I could stop there if I'm happy with my calculation and save some time. I'll do the others just for completion, but in an exam I wouldn't be doing these other ones. So mixing and finishing, beef requires 0.4 and there's 4 batches, so that's 1.6. Chicken requires 0.5 for 4 batches is 2, and veg is 0.3 for 3 batches is 0.9. So that's 4.5, and there are 5 available, so not a bottleneck, no surprises there. Bacon, 2 hours for 4 batches is 8. Chicken, 2 hours for 4 batches is also 8. Veg, 2 hours for 3 batches is 6. That's 22, and there's 24 available. So just confirming it is weighing and chopping as the bottleneck. Assuming they want to maximize profit, what's the optimal production plan for Wednesday in batches? Due to urgent maintenance, mixing and finishing process is identified as the bottleneck. On this day, only 3 hours in the process are available. So mixing and finishing, instead of 5 now, we only have 3. So we need to work out how many batches of each we'll produce. And to be efficient, I'm actually going to just add this to my table below. The next thing I need to know is the throughput contribution per unit, which is the selling price minus the material cost. So for beef, it's 450 minus 125. So that's 325. For chicken, it's 4 minus 105. So that's 295. And for veg, it's 350 minus 75, so that's 275. So this is per unit, but now I need per batch. If it was the case I just needed to rank them in order, I wouldn't need to do this stage because there's 30 units in a batch for all of them. But because I need to calculate the number of batches, I will need to do this. So I'm going to have to multiply each of these by 30. So that's 97.5, that's 88.5, and that's 82.5. Next, we need the amount of mixing and finishing time. You may not need to do this, you could just read them off here, but I'm going to put them in just so it's clear where my numbers have come from. 0.4, 0.5, and 0.3. And then we calculate the throughput per hour. It's actually the throughput per batch per hour, but that's complicated to say. Throughput per hour. The 97.5 divided by 0.4 is 243.75. Then the next one is 88.5 over 0.5, so that's 177. And then finally, 82.5 divided by 0.3 is 275. So when you've got a limited amount of resource, as we have here, you'd prioritize the one with the highest value here, which is veg. There are 3 batches of veg, so you would make all 3 of those. Now we need to make sure that we don't run out of resource. We know we're going to make beef next because that's the next highest. I could make a bit of an assumption because 0 isn't an option. I know I'm going to have to make some chicken, so I can assume that there'll be 4 beef. Because if it was only 3 beef, then there'd have to be 0 chicken, because I would always make as many beef as I can if there's available resource. So let's look at what we've used. We've got 3 batches of veg, each using 0.3, and we've got 4 batches of beef using 0.4. So put it into my calculator, means I've used 2.5. I've only got 3, so I've got 0.5 spare. So how many batches of chicken can I make? Well, mixing and finishing uses 0.5, so I can only make 1 of those. Finally, how much will profit increase if the company hires the new oven, produces as many beef pies as possible? On Friday, due to a local food festival at the weekend, they consider an increase in production of beef pies. These pies can be sold at the festival at the existing price. Company has unlimited capacity for weighing and mixing processes on Friday, but its existing 3 ovens are already fully utilised. Therefore, in order to supply the pies, they need to hire another identical oven at a cost of 150 for the day, and it will be utilised for the full 8 hours. How much will profit increase if they hire the new oven? So we can ignore weighing and chopping and mixing and finishing. We just need to take into account baking. So they've got 8 hours. It takes 2 hours. They'll make 4 batches. 4 batches means 120 pies. And make sure you don't stray into a contribution approach. We're told that they use throughput accounting. There's nothing in this question that suggests they've stopped using it. So 120 pies, and the throughput contribution per pie is 325. So that's 390, but that's a distractor because they also need to add in, or rather subtract, the cost of the oven at 150, which gives 240. On to the Peloton group, questions 26 to 30. Which of the following options is the correct ROI using the old method? It's definitely going to be a calculation there. Calculate the ROI. We can see there's some calculations here. Which of the following is a valid reason for choosing to use ROI rather than ROI? Feels like there's a lot of information to incorporate there, so I would hold off doing that one. Which 2 of the following is a true statement about this opportunity and management behavior? It looks like there could be some calculations, so I'm not going to go ahead and do that one. Which of the following could lead to an increase in management bonus without benefiting the organisation? Again, just briefly looking at that, it looks like it could pull information from here. So there's none that I will do before reading the bit on the left. So Peloton Group, the Bikes Division, Division B, and the Treads Division, Division T are two divisions of the Peloton Group. Whilst both operate in similar markets, each division operates separately as an investment centre. Each month operating statements must be prepared by each division, and these are used as a basis for performance measurement for the divisions. In the past, ROI has been calculated using controllable profit. Last month, Senior Manager decided to include all fixed costs and recharge head office costs to the divisions. Consequently, each division is now going to be required to deduct all fixed costs and a share of head office costs in its operating statement before arriving at net profit, which is then used to calculate ROI. The target ROI is 25%. For the last 3 months using the previous controllable profit basis, divisions B and T have been above this, resulting in healthy bonuses being awarded to staff. The company has a cost of capital of 10%. Budgeted operating statement for the year is shown below using the new basis for calculating ROI. So we've got sales revenue, variable costs, contribution, controllable and uncontrollable fixed costs, apportions head office costs, and divisional assets. Peloton Group's concerned about the behavioural effects of its performance measures and want to encourage goal congruence. So we want to do the ROI calculation using the old method. As every answer is different, we probably just need to do it for one or the other. If we want it to be efficient, let's look at bikes. So the used to use controllable profit, which is the contribution of 960, and we subtract the controllable costs, is 840, and divisional assets of 3000, gives 28%, which is option 4. We can use the other one to check. Contribution is 600, minus the controllable fixed costs gives 540, and divisional assets are 1600, 33.75. Calculate the RI for each of the divisions based on the new method of net profit figures as calculated in the table. The divisional manager directors have heard of a performance measure called residual income, which may provide more information and be a better measure for the bonus. So we've obviously got two calculations to do here. So residual income is the profit minus the imputed interest, and the imputed interest is the assets multiplied by the cost of capital. Using the new method, so this is after deducting the head office and uncontrollable costs. So this is 480 for bikes minus, and it's 3000 net assets multiplied by, the cost of capital is 10%. So that's 480 minus 300 is 180,000. And then for the other division is 240 minus, and it's 1600 times 0.1. So that's 80. Which of the following is a valid reason for choosing RI, not ROI? Two of the divisional managers disagree on the performance measure which should be used to determine their bonus for the year. Manager 1 is the manager of the larger division, Bikes, while Manager 2 is the manager of Treads, the smaller division. Manager 1 prefers to use residual income and given the following examples of the limitations of ROI to support this decision. First, ROI requires an estimate of the cost of capital, a figure which can be difficult to calculate. So ROI doesn't need a cost of capital in order to do the calculation, but often it does in order to do a comparison. But RI needs the cost of capital definitely to calculate, so that's more of a limitation of RI. ROI can emphasize short-term performance at the expense of long-term performance. Whilst true, that is also true of RI, so that's not a differentiator. If assets are valued at net book value, ROI figures generally improve as assets get older. This can encourage managers to retain outdated plant and machinery. It is also true, but true for both. ROI is a relative measure, therefore small investments with a high rate of return may appear preferable to a larger investment with a lower ROI. However, the larger investment may be worth more in absolute terms. This one's true and is one of the limitations of using a relative measure. Which two of the following is a true statement about this opportunity and management behaviour? Division T has been offered an immediate opportunity to invest in a new machinery costing 2 million. The machinery would be expected to expand Division T's production capacity, resulting in an increase in profit of 450 per annum. So we'll need to do the calculations for this, otherwise we will not be able to compare with the benchmarks that are given over here. So the ROI is 450 over 2 million, is 22.5%, and the RI is 450 minus, and it's going to be 2 million times 0.1, so 250. So based on ROI, this opportunity will be rejected by the division and accepted by the group. Well, the ROI of this is 22.5. The company's target is 25, so it wouldn't be accepted by the group. So that one is false. Bye. Option 2, the division will reject based on ROI but accept based on RI. Well, the RI is positive, so that would lead to acceptance. The ROI is 22.5, but the target is 25, so that would be rejected, so that's correct. Both the division and company will accept based on RI. Yes, a positive RI makes it acceptable. Based on RI, this opportunity will be rejected by the division and accepted by the group. Well, that's not true. As we've just said, positive RI, both would accept. Which of the following could lead to an increase in management bonus without benefiting the organisation? Option 1, manager holds on to heavily depreciated assets in order to avoid heavy investment in the period. This is one of the ways that managers can increase their bonus because it reduces the assets, reduces the capital employed, which increases ROI and also increases RI. But they're more likely to break down, perhaps higher running costs, higher maintenance costs, and so it's not benefiting the organisation. 1 is true. 2, a sales manager changes their fixed target to a relative target based on market share. This one's a little bit harder to work out. What we're looking at the top here is we're looking at dysfunctional behaviour. Changing to a relative target isn't dysfunctional behaviour. It can actually benefit the organisation because it reflects actual market conditions. So we'll reject 2, which means it has to be this one, 1 and 3. Option 3, divisional manager of a buying division buys internally from another division at a slightly cheaper price than they can get, that should be than they can get from an external supplier. The selling division's at full capacity and cannot sell to all its external customers as it would like to, losing contribution on these sales. The lost contribution is higher than the increased cost from the external supplier. So this is asking, is this transfer pricing example here dysfunctional? Well, the buying division buys internally because the price is a bit cheaper, so it improves its own performance. But because the selling division's at full capacity and loses those external sales, it loses that contribution. And this is the important bit, because the lost contribution is higher than the increased cost from the external supplier, then that's not within the benefit of the organisation. So confirming that it's 1 and 3.